Hi, everyone. Welcome to one of our last information sessions. We'll be running a investor pitch session for today. So for this session, we have both Jason and Niel, both out of YBF. Jason has a little bit more experience. I'll let them explain or give introductions to themselves. This has been one of the actually unplanned but most requested areas of knowledge that we've been asked for. So hopefully this is something that you guys find helpful. Please make sure we have a few set questions that Niels have and Jason have kind of composed, and also happy to go off track of those questions. Feel free to put them into the meeting chat or kind of ask, raise your hand and ask up front. So Niels, Jason, I'll turn it over to you guys.
Thanks, Stephen, and thanks everyone for joining today. I've met a few of you in person. I've met a few of you virtually, and I can see, Fiona, that you're dialing in from YBF Sydney as well, which is great. I recognize that shade of blue in the background. So again, thank you for coming in today. The chat today is really about all things investment, and we're going to be debunking venture investment, which for a lot of people seems like a arcane form of finance, given the amount of crazy terms and acronyms that are thrown around in the industry. For those of you who I haven't met yet, my name is Jason, and I'm the Chief of Staff at YBF. I've been with YBF since 2012, so I've been following the growth of the Melbourne ecosystem since the early days that it's really kicked off. And I'm sure a lot of you are familiar with Niels. Niels is the Chief Strategy Officer, and obviously with an extensive career as a CFO or CFO equivalent roles in Coles, Wesfarmers, Nimble, and whatnot. So the format of the talk today is we'll be going through a few general questions for about 30 minutes. After that, we're going to take a pause to make sure we answer any questions you might have. And if there's time left at the end, we'll open it up for a general Q&A, and we can take a tangent across different topics as well, and not specific to finance if we need to. So to kick things off, the areas of investments in startups, there are plenty of it. There's venture funding, there's equity, venture debt. A lot of it can be really unclear. So I think a good place to start is Niels. Could you just explain some of the key terms in venture financing for us?
Yeah, no worries. So there's a whole bunch of jargon here, and I think this first part of the chat is just going through and making sure that we kind of have a general understanding of some of the terms, right? Like Jason said. So when you talk about kind of venture capital, it's really the type of investment that fits in the kind of startup space. It tends to take more risk. It tends to take smaller amounts of money. It sits kind of underneath something called private equity, which is funds that basically invest larger ticket sizes. The other term you'll hear sometimes is venture debt, as opposed to venture capital, which is kind of the equivalent of people lending startups money. So when you look at, sometimes when you get venture investments, people tend to knee-jerk and think that that's around equity. So someone takes a piece of your company in exchange for money. They check they write to you. These days, there's also mechanisms where people have funds that do venture debt. So if you have some cash flow, and that cash flow is basically, hang on, did you write something? I just kind of.
I just pasted the questions. I just pasted the questions into the chat, so you can kind of
awesome. Cool. I just want to make sure that you weren't pinging for a question, because I know you're an active questioner. So anyway, so that's kind of the debt and the equity part, and then you go into terms like when people talk about Series A and Series B and some of those terms. The reason why people call these areas series is because no startup starts and immediately gets $1 billion from an investor right away. That's for a couple of reasons. One of the primary reasons is no one would give someone with a good idea $1 billion without having to prove that $1 billion will have a return, right? So the way this is set up in series is basically you start with some seed capital and you spend it, and then you still don't have enough funds yourself to fund the rest of your growth. That's very rare. So you go for a next round of investment. That next round of investment is often called a pre-Series A or a Series A, where basically you raise a moderate amount through a bunch of investors that will fund the next part of the business in exchange for a piece of your company. And so what can happen is people get into Series B, C, D, E, because as long as you need to go back to, say, the investors to raise money to fund your growth and to fund your expansion, and you don't have the cash flow yet to fund that yourself, the process perpetuates. You have to keep going back to investors. Sometimes that doesn't happen a lot. So if you look at successful examples like Amazon, in the case of Amazon, they broke even somewhere in 2001, and they've basically been at a zero loss since 2001, but their revenue has been growing. They've expanded obviously a lot. The contrary, if you look to Uber, Uber is one of those companies that still loses, 4, 5, 6, 7, 8 billion a year in cash, which is the difference between the money they spend and the revenue they generate. So they have to keep going back to investors, even now, as big as they are, at as big amount as they are, and have to keep raising money. So as a founder and as a startup, operator, you have to have a think about how you carve the path with investors and what that journey looks like in order to be able to hit the large growth that you want for yourself. Do those terms so far make sense? Jason, any thoughts on like Series A, B, C, things that you are, things that you have seen or terms that you think some people find confusing?
Yeah, sure. I'll also add that, there's another class of investors called angel investors. So you've got angel investors, you've got venture investors, and you've got venture debt investors, I suppose. And they all have very different risk profiles and very different reasons for putting money into your company. Angel investors are typically, high net worth individuals who are passionate about a particular problem that you're trying to solve, are passionate about the team, and they're genuinely willing to fund based off the back of a vision or a team. So they're, in a sense, a bit more high risk. And they certainly don't expect a return to some degree. Venture investors obviously seek a return. So if you take money from a venture investor, they're looking for the next Airbnb or the next Facebook. They need a return of 5x or 10x of their fund, or even 100x of their fund. So different investors have different kinds of risk profiles to when they put money into a company. The other thing to be aware of, I guess, in terms of funding stages is there's a stage before the Series A, B, and C is called the seed rounds. These rounds are usually pre-product market fit. When you're just starting up the company, you'd raise what you call a seed fund, and true to the image of a seed growing from the ground, it's really to help those little buds of your company really sprout. And in Australia, at least, seed rounds are usually quite small. They're usually below $1 million. When you start talking about Series A or B or C or D, those are typically above $1 million.
Yeah, that's awesome. So a question here on convertible notes. So that's another way to raise money. Sometimes people abbreviate that to call notes as a jargon term as well. So you might hear that. So a convertible note is really basically a piece of debt that can convert into ownership of the company over time. It does happen, but it also has sometimes connotations around what people find as positive or not so positive. So convertible notes sometimes are seen as a weaker proposition as straight equity, and there are some investors that don't see that as a sign of strength for the company if they open with a call note. So it is an option, and sometimes people do use it, and it can actually, I don't think it is a sign of weakness necessarily, but I have noticed some investors that need, especially in the kind of private wealth, like the high net worth kind of style investors, that sometimes hold their noses a little bit around kind of when someone offers, why don't you do a call note? They basically, their reaction is, why don't you just let me buy a piece of your company? Like, why would you do a loan kind of component around this? So sometimes you have to work a little harder to explain why a call note is the right thing, of why you're asking for that. So it's definitely there. I see people use it a lot. It's a very viable instrument, but there's also a little bit of a kind of a side connotation sometimes I notice here in the local market, which is kind of odd. Jason, any thoughts on call notes?
Yeah, I mean, with the con note, people are usually trying to solve one particular issue, and that issue is how do I value my company? When people put con notes in, it's usually because, at the early stages of a company, you don't actually know if your company's worth $1 million or 10 or 20 mil. So what a con note does is basically defer the conversation about valuations. A con note is essentially a debt instrument to say that, the investor is effectively lending me money at a rate of X% interest per annum, and it'll mature in maybe a year or two, or even when you raise your next round of capital. Usually with con notes, there's a stipulation there that says, at the point of raising capital, there's some way of figuring out valuations. So whether it's you setting a valuation ceiling, or it might even say, we'll take the valuation at the next fundraise, but we'll discount it for you taking the risk of putting in money so early. So that's effectively a con note, a debt instrument that's convertible into equity at some point in the future. The other mechanism, as an alternative to con note that people are starting to use, well, people have used at least more so in the US than here in Australia, is something called a safe note, or a simple agreement for future equity. It's very similar in nature to con note. The difference is that a safe instrument is not debt; it's literally an agreement for equity. And it might sound like a very small difference, but when you put in a safe, you're not talking about what the interest rate is. You're not talking about whether or not the debt is repayable, which can be the case for a con note. Investors might have the option to convert into equity or to claw the money back. With a simple agreement for future equity or safe, you don't have that option. So it's really money for equity at a future point in time, and you're deferring the conversation about valuation into the future.
Awesome. Shirley, you have a question?
Yeah, Jason, with the safe note, well, I have two questions. I assume that the beauty of the safe note is it doesn't have the same sniff and smell as the convertible. And what you're really doing is just saying it's too early to value, so we'll value when we can. But what's the mechanism for ensuring that you don't deadlock on valuation?
Yeah, good question. With a safe note, you usually have a ceiling on valuations, or a valuation upon maturity, I suppose. So you typically also say, I'll have a maturity date of, say, 2 years into the future, and if in 2 years you don't raise any capital, you'll set a ceiling of X valuation, and that will be the valuation at which it converts. Some safe notes do that. Other safe notes don't even have a maturity date, so there is no way to deadlock unless you raise capital. But that's more common in the US than here in Australia.
And so if you go under, then it's the risk of the person holding the safe note. So it's really it's a high risk strategy for a funder. So it's a family and friends mechanism.
It is, yeah, it is a family friends mechanism, and a lot of early stage investors here in Australia have used that mechanism as well because they are familiar with it. If you go to a more traditional investor, chances are they'd be more familiar with the con note than they are a safe note. And so safe note templates are available online as well. AVCAL, the Australian Venture Capital Association, has a free safe note template that you can download. Y Combinator has a free safe note template that you can download, tailored to the US. But it's a good robust note that you can modify to fit Australian needs.
Thank you.
Awesome. All right, I think that's for like series and angel seeds, those kind of terms. That kind of covers a bunch of them. I think maybe we go to the next one, which is really around kind of startups and scale ups and what's the kind of process and how you start looking for funding. Sorry, there was a question?
Oh no, Fiona's just asking about
the question was, yeah.
Got it. It's just you get a loud ding when that thing comes up, so I just wanted to make sure. Jason, I mean, you've been kind of looking at this space since 2012, and you've seen lots of people embark on this kind of initial kind of fundraising kind of journey. What do you see as kind of like your typical, or an average process of, you see someone with a good idea, they start working on it, they come to YBF, they collaborate, they hit this point where they go, look, we need to get some funding from somewhere to keep going. Like, how do you kind of experience that with them? Like, what are you seeing them go through in those initial stages?
Yeah, good question, Niels. If there's a common thread I've seen in terms of people successfully raising investment, it's building the relationship with the investor extremely early on, even before you need to raise funding. And a lot of these people do that by immersing themselves in startup communities like YBF and Inspire9 and other startup spots, I guess. We think YBF is the best, although I'm biased. Participating in angel investment network dinners just to get in front of investors, things like that. It's getting harder to raise funding in Australia because there are so many entrepreneurs out there right now, which is a good thing for the ecosystem. But that means you're up against some really impressive companies and some really impressive ideas. When venture investors put money into a startup, a lot of it is really backing the team because ideas are plenty. It's all about the execution and the team. So building a relationship with the investor early on really helps create a vote of confidence in who you are and what you're doing. Niels, are you seeing anything else as well in terms of being able to, successfully raise funding?
Yeah, no, I think that is definitely I think the key tip here is, in general, when you have a startup, no startup can build its solution in isolation. You need a cloud of allies around you that you can tap into, and so the same goes with your investors. And we'll talk about this later with boards and advisors and things like that. You kind of need to have relationships before you need those relationships for, practical terms, which means that you spend a lot of time, as if your job wasn't busy enough building your solution and working on sales and, talking to customers, creating this network of kind of advisors around you and, people that can help you think through is really crucial. And interestingly, a lot of benefits come from having really good investors and even, angel investors and forward around you. And, every investor will go and ask you, why do you want us as an investor? And the simple answer in your back of your head is, well, we need the funds to grow, right? But that's never the right answer, because you shouldn't necessarily just want that investor for the money they bring, but two other really important reasons. One is they're on it with the journey, because now they're financially tied to you, and they're your success is kind of their success. So they are bought into the fact that you need to succeed. So they become potentially an incredibly important ally and supporter and coach. And they've likely made a lot of investments already. They know a lot of companies. They've seen goods and bads, or they've been wildly successful in their own lives. They're often really, really good advisors and supporters, even at the seed stage. And then later on, the second one is they help you find those next investors, because they're kind of a seal of, confidence and a seal of approval that if they've gone in, other people might feel a bit more comfortable because someone they respect in the community. So when you talk to investors, it's kind of start early with those relationships, build those relationships, get to a point where they're comfortable putting their money in, but then continue building those relationships out even further, because they'll help you basically from the ground floor to on all those other kind of journeys that you have to go through. So it's crucial that you see investment as a journey, as a set of relationships that grow, and as a way to create, allies around you before you've raised money, during the raising of the money, and then after you've raised the money. Those allies have even increased.
Yeah, that's great. That's a great point, Niels. And I think there's a really important distinction to be made between the cold intro and the warm intro as well, as two ways to get in front of an investor. Investors get hundreds and hundreds of pitches every single day. That's for a fact. The cold intro is you just finding the email online, sending an email, say, hey, here's my pitch deck. Have a look. I mean, that's probably not going to be effective, because it's probably going to be triaged into some central email that then gets distributed, or it goes to the associates who can't really make a decision. You really want a warm intro, whether that's you building the relationship personally, or as Niel said, getting a warm intro from an advisor. Hey, can I get intro to a venture fund, or even through YBF? Hey, YBF, I'm looking to get in front of Blackbird or Airtree. Can you introduce me directly to a partner there? That's a lot more effective, because you get a lot more cut through to the investor as well, and doesn't just go into an inbox that will be ignored for a couple of weeks. Fiona, you had a question as well on valuations. Should we move on to that one, to Fiona's question?
Yeah, it's a question on COVID, on kind of valuations and funding, and I think it's a really good one. I think, Fiona, what we see a lot is that it's been quite a Darwinian year, where we see a lot of money that has been kind of taken out of some areas of startup land and some money is really flown into other areas at wholesale. So if your solution has, a positive, if COVID has had a positive impact on your ability to grow, so think about video conferencing or remote work or process automation or ways for people to work from home and do the same thing rather than have to come to the office because it's now no longer paper, and you can create that story around your startup, I'd say your chances are probably the same, if not better, because we've seen kind of a wedge between where the money is going globally. That doesn't mean that Australia isn't a hard place to raise money, because it is, and it's always been. And I think COVID hasn't obviously helped that, but it has been a bit of a K-shaped effect in the trend lines, where some people have really benefited from the crisis because they've pivoted into areas that have been, conducive in the current environment, and some people in, say, hospitality or other places that relied on large, groupings of people, a lot of the money has basically been sucked out of that completely. So it's a more complicated question to answer, but it's definitely, been a benefit if you've been able to pivot or be in an area where you can articulate that your solution is now more valuable rather than less. Does that make sense, Fiona? Or awesome.
Maybe just
Yes,
Niels and Jason, to an extent, you know the cohort a little bit more. I'm just wondering if you can maybe target that previous kind of answer a bit more. So where do companies like Family Property, approximately their size and scale, Elker, who's just kind of on the first hunt, where are they kind of like seeking maybe their first bit of funding? Where does it typically come from a company like theirs? And do you have like a story to share from a resident at YBF?
Yeah, that early stage kind of funding really often comes through that angel and seed kind of area. It's building relationships with someone who buys into your journey, and using those kind of angel networks and places where you meet seed investors, or if you have people that in that space, and building relationships with them, because you're looking for someone to place a bet on. The other one that is kind of crucial in this space is that you decide when you need to start looking for investment, because sometimes you can sweat equity, you can kind of bootstrap, as they call it, which is fund your own growth until the point where you need the money. So the question in your head always is, if I had the money that I think I need to raise, what would you spend it on? Like, what's your shopping list really, and do you need to buy those things right now at this stage of the game? So if you're at the stage of product market fit, your purpose should be to have product in market that is being valued by customers, and customers are starting to ask you to install larger sets of this, across, your legal tech helper, your Elkers, you have this push around, how do I get a product that fits from a value proposition perspective that customers have in their hands, that we can engineer together, and then we can grow it and scale it up. You make that decision when you need the money and what you need the money for. Do you need extra staff? Do you need extra capability? Do you need to, have some developers in place? That's the point where you start going, I can either do that through sales, but if that isn't going quick enough and I still need to be in the market, that's when you start talking to those seed investors and things like that. I think that's kind of the one. There's a question from Shirley here on kind of, do we run angel parties? We don't, but we do have really great relationships with your Australian angel networks and female founder seed circles and all those kind of organizations. So we can definitely point you in the right direction. If you go, look, we're ready to go and be part of that, we can compile a bit of a list of things that we like, and you could kind of do if that's of interest. Does that make sense, Stephen? Awesome. All right, great.
Samantha had a question as well on the chat. A reminder about how much equity you would give up at seed, Series A, Series B, etc.
Yeah. What's your view, Jason? Any thoughts?
Yeah, honestly,
as little as possible is the answer.
Yeah, as little as possible would be great. Practically speaking, I mean, it's more art than science, really, Samantha. I mean, in an early stage of the company, how do you value a company? You kind of lick your finger and go with the wind. But I mean, a good way of doing it is, finding comparables in market. For example, we know for a fact a lot of the early stage accelerator programs, give away maybe 100 grand for about 10% of your company. That's quite common. So effectively valuing your company at $1 million. So I think, if you were an early stage company, you'd benchmark yourself against that and say, hey, this accelerator is taking 10% for 100K, and my company is at a similar stage to all these other companies that have gone through the program as well. And you probably do the same thing as well as you grow into a Series A, Series B, etc. What you do is, say, hey, this company has raised X dollars. We know they're doing X revenue, which is, and the valuation is 5 times a multiple of their revenue. So you take the same metric, 5X revenue or 4X revenue or whatever it is. So that's, those are different couple of mechanisms. I mean, a lot of founders also raise just on hype alone. I mean, you can't do a revenue multiple when you're not making money and you're just plowing investment into growth. So a lot of them just raise based off the fact that, hey, we've grown 10 times in users, so our valuation is 10 times what it just based off metrics like that. Niels, any other advice?
I think one of the things that I think is valuable that investors already know, like if someone is a good investor, they get that, and it's something you can bring up in those conversations if they start, pushing for too much equity in your mind, is that it's actually not that helpful for them to take too much equity, because what will happen is it'll take horsepower away from you to do new rounds, right? So they know that when they come in at a Series A, before you become, the new wildly successful global enterprise, there's going to be, a Series B, C, D with bigger and bigger amounts that they're not going to be able to or don't want to do by themselves. And you as the company need to be able to give equity to those investors in those future rounds. So let's say they take 40% of your company at a Series A. That means in the Series B, you'll likely become the minority shareholder of your own company, which basically means your entire incentive as the controlling party of that particular company goes away in 2 funding rounds. And that's not something an investor necessarily wants to push for, because they need you to feel like it's your company and you own this thing and you have skin in the game. So they get that if they push too far with this percentage, that it's a problem. So then the discussion really becomes, if we only want to take 20 or 25% of your company, how much are we willing to attach to that in dollar terms? And is that enough for the shopping list on your fridge to be fulfilled? Right. So there's a balance there between, they also don't want to push it over the top because they know they're part of the journey, not the end point. And at the same time, you then have to assess whether they value your company with enough dollars to cut a check that's big enough for you to fund your growth. All right.
I also have some resources from a session I attended on startup maths from a separate company, and maybe I'll include that. They provide some Excel tools to actually look at what your number of shares are, how that impacts your valuation, and then give you some tips on what it means to put away that money or put in that money. So I'll share that after this as well.
Awesome. Yeah, there are great resources online in general. So some of the startup school stuff, the Y Combinator, some of the stuff Stephen will send around. There's a lot of stuff on there that is just fact, and you might have to localize it a bit to Australia, but the high level kind of concepts and structures and things to watch out for are quite consistent. And I think just as a founder, as an operator of a startup, it's a great way to kind of get informed that, no dollars to spend. It's just something that you can really learn there as well and just validate it. Question from Shirley on taking money off the table and salaries for founders. Shirley, what did you mean with taking money off the table? Sorry, you're on mute, Shirley.
Niels said, and I got this advice from you earlier, which is it's about working out how much you can fund by bootstrapping or sales, right? And then the thing about that is that when you're bootstrapping and sales, it usually means the founders are putting in money themselves. And so at a point in time, the question I suppose I have is that, as we all know, these are high risk propositions. So what I'm wondering is, what is the protocol, and is there a protocol around potentially, when you get the first round of funding, taking some of the money off the table, meaning if the founders have put in 250 to $500,000 for the build, taking some of that back out of the raised capital, just so you don't have all the founders sitting around the table with huge mortgages, which is also over the long term an additional stressor. And same with salaries. Yeah. A lot of the time the founders take equity in return for huge salary cuts, but you know, that can be a 4 or 5 year proposition. So same as that, how do you go about, and at what point do you go about with someone who's funding, negotiating proper salaries for some of the founders, particularly the younger founders?
Yeah, it's a fantastic question, and it kind of continues much longer, even when people are wildly successful, these kind of relatively low salaries, especially because there's people hope just for being able to take money off the table after, for example, the company's gone public and it's publicly traded shares, and they're no longer restricted, and you can start kind of turning those things out a little bit and kind of taking some money off and selling some of your shares. But I mean, you look at a current example, say Afterpay, that's been wildly successful, it's been listed, it's grown a lot, valuations are high. If you look at the base salaries of, you know, the CEO of an Afterpay, currently I think it sits at 300K base salary with not a lot of, you know, short-term incentive kind of bonuses. So these are companies that are now global. They are, you know, 1,000+ staff, tens of thousands of customers in the retailers they have, and the base salary is 300K. So even with those wildly successful companies, if you compare that to corporate world, those people would have earned maybe 2-3 times that money. You know, if you're a CEO of one of the, you know, larger financial services companies, that's not an abnormal amount to earn. So it does continue. It is a life that tends to be higher risk in the sense that the salary component at every part of the journey is less than what you might expect, especially in the beginning. And I don't know a lot of times where people basically out of a Series A or B, you know, that money is basically a check for growth. If you talk to an investor and say, of that check of $1 million, we'd like to take 200K and pay ourselves some of our investment back first, and then another 300K for the 3 founders to get 100K a year. Basically what the investor hears is, you're only going to put 500K to work on growth of my 1 million check. So that's a tricky conversation to have, because they're saying, look, I'm giving you 1 million. I want you to get to 5 million revenue by, you know, run rate by X time. And I'm going to help you with this million. But if this million turns into 500,000, then your chances of that growth become smaller, because in the end, you're using it to plug past holes as opposed to using it for future growth. Jason, any thoughts on that?
Yep, no, I agree completely. You know, on one hand, it's been, you know, easier than ever to raise capital because you've got so many investors right now and you've got billions of dollars floating around the market. On the other hand, it's also been harder to raise investment because you're now up against all these great companies and great founders as well. So, you know, I think the conversation about whether or not you can take money off the table is also, you know, a practical question of, you know, whether you are a good company. You know, at some stage, if you are successful with your company, you'll realize that investors are actually going to fight to be able to put money into your company. You know, if you think about, you know, an Afterpay or a Culture Amp, or, you know, a Canva, these are companies that can have their pick of the investors, any investor they want. And, you know, having the ability to take money off the table is something that they probably package into the conversation as well, because they have that much market power. So I guess you also have to factor in how much, you know, negotiating power you have versus the investor, what stage your company is at, and depends on, you know, how successful you are as well to some degree.
But the reason that it's such an interesting point, and I want to check I understand it, is because what you've just said to me is, when you're thinking about how long you want to bootstrap or invest yourself, the really important thing that you need to think about is that that's not money you're going to be able to pull off the table easily till very late on. So you don't want to leave that seed round too late because if you've sunk in more than you can afford to personally secure, you run the risk that that's a hole that you're not going to be able to fill for 5 to 10 years.
Yeah, that's correct. Yeah.
Okay.
Sorry. And sorry, the other interesting trend as well is that, time to exits have actually increased over time. Historically, startups tended to exit in 10 years, 8 years. By exit, I mean get acquired or go public. Recently, it's been 14 years or even longer than that to exit, especially for Australian companies at least. So what you're finding as well is that there are a lot of funds right now being created specifically for secondaries. So specifically to purchase shares of founders or other investors and who want to play at a later stage. That's becoming more common, but again, those are things that they'd only come into play when your company is slightly more mature.
Yeah, and then I think the last point on that one, Shirley, is that I think it's better to see taking money off the table and salaries of founders as relative to revenue as opposed to relative to investment. So it's basically the circle is I raise money so I can grow my revenues, and out of those revenues I can pay salaries. So if you think that with bootstrapping you can raise revenues enough that you can support the founders and the staff with the revenue that comes out, you can perpetuate bootstrapping for quite long. There's companies that have bootstrapped without taking any public money or any investor money or external money, sorry, for very long in the journey. And the reason they were able to do that is because they had a SaaS model that was getting them a lot of revenue dollars. People signed up by a lot. They used that to reinvest in salaries and their growth, took a little bit of money where they needed it, but not in relative terms, grew more revenue. So if you find yourself in a position where revenue grows a lot and you don't need to get a lot of investment up front to create the widget that drives that revenue, you can bootstrap probably longer. Whereas if you need a large, like if you build a neobank and just your equity block for funding of your customers needs to be 100 million, you have to go in hard on investors from day one, because you can't start a neobank with a balance sheet of 500,000, because you'd be able to fund 5 customers and then you're done. So there's a difference in the business model and differences in the way that you can choose to bootstrap, but it's really relevant to the amount of revenue you can generate while you're bootstrapping.
Great, thank you.
That makes sense. Samantha, really good question on female founders and where the VC funds are going. It's definitely something that is on YBF's mind, and we try, and it's more dimensions of diversity and inclusiveness in general that there are concerns around this. And in fintechs, for example, 81% of fintechs are 100% male founding teams at the moment in Australia, and that's Australia. I think investors here are a little bit more focused on diversity and kind of have an open kind of relationship with local companies. I would say personally, if you look at the UK, for example, I get a lot of anecdata over the last kind of 2 years where investment companies literally go to a female founding team and go, you should add a male founder because you'll have an easier job raising money. And I haven't heard that here in Australia, yet, or as much. So I think we're slightly better here in Australia on kind of having investors be more open. I think the biggest problem with investors in Australia, especially in the VC space, is that they talk to each other too much. It's a group of maybe 15 higher profile VC companies. And when you pitch to one, they talk to each other and they go, hey, have you guys seen Elker? Yeah, we've seen Elker. What do you think of them? And if the answer is, you basically close the door of all 15, right? So it's not a cartel kind of thing. They don't do it because they want to invest as a block, not at all. But they're kind of friendly with each other and they do talk and they have coffees like everyone else. So your timing and when you start talking to VCs is really important, that you do it out of a position of kind of strength and know what you're doing. But don't go and set yourself up for a position to fail, because you're very likely that if you've had a bad experience with one, that's permeated with the other 14 that you can talk to in the market. So just be careful of that dimension in the background, that can sometimes affect, and shut some doors that you haven't even had a chance to have a chat about that with them.
Yeah, and actually that's a great segue to the next question, Niels, which is, as an investor, what do you look for in companies? What factors or signs are important, and how do you make that good first impression when you're talking to an investor?
Yeah, that's such a valuable conversation. I think the cliche is that it's all about the people, but like with a lot of cliches, in this case, it's absolutely true. Most of back a group of people they believe in, competent, good plan, believable plan, ambitious plan, great solution. That is a very appealing kind of investment to make, as opposed to it's a great idea with a great plan, a great financial model, but the people seem flaky, they don't deliver, they don't seem to have answers, they don't know their business model well. So it's investing is a really human experience. It isn't a brochure you choose to invest in. It's meetings between people, and I think that really starts to become more and more important as you kind of go up to kind of Series A kind of route and start raising money and build that relationship. The other one is traction. So if you go and if you're a company that goes, look, we have a great idea, but we really need investment in order to get to the customers we need to prove our model, that's one position. But if you go to an investor and say, look, we're just so stressed because 100 people have booked orders, we have no way to deliver on them. We're going to deliver a really bad proposition because we want to say yes to all their revenue, but we just don't have the capabilities to deliver on that well. I think we're just going to be a victim of our own success and fall over because we just can't deliver on the growth that people are asking us to deliver on. Now, if you're an investor, that second one is pretty appealing because you go, oh, you already have the orders. People love your stuff. If I help you grow and build the capabilities, you seem to be doing just fine on where you're going, and this is just meeting the demand that's out there. So how you position yourself on traction is really crucial. If you have a good vision, good product, good ideas is one thing, but if you can really demonstrate that orders are falling out of your ears, and you're just really nervous that on how you'll be able to meet that demand and the stuff that comes from that, that's a really nice kind of position of strength to go and talk to investors about, because they love that stuff. Any questions on that, Jason? Any other thoughts on that aspect of what people are looking for?
No, that's great. Shirley has a question that's related to what you just spoke about. I know, Fiona, that you've put in a question as well. We'll circle back to that after this one. But Shirley's question was, for a pitch deck, how much do you put into that?
Yes, I like pitch decks that actually flow on almost like a templated way. So pitch decks that really go through what's the problem I'm trying to solve. How I design my solution. How does that solution really work? How big is this market that I'm trying to pitch this into? How does the unit pricing on this stuff work? Is this something that over time will become effective? Here's a business model canvas where I combine all the different facets of my business into costs and revenues high term. And then a really important thing that I see a lot of people miss is tying the future promise to the short-term delivery. So think of your your future in 3 phases. What you're delivering now, like what's immediately relevant that you have to work on to make it a success. Where does that success then step into? And then what ultimately can be the North Star of what this proposition can become. Because investors are testing for 2 things. Is this a big enough opportunity for me to invest in? And can this team deliver on the journey? And you basically create 2 points in the pitch. You say, this is what I'm delivering now. Here's my list, very detailed. Here's where I'm headed. So people can go, they can deliver on this role. I believe they can make this step up. And then ultimately that leads to this, $1 billion opportunity that's out there. So if you can craft that in like a horizon page, and then you have a follow-on page that really shows, here's how I'm going to deliver on step 1. I need funding for step 1 to the tune of X dollars, which will allow me to do the following. Then people go, okay. So they're solving a big problem. There's a big market out there. You can add things like, who else is doing this? Have a slide that's titled, why is nobody else doing this? Or what are the alternatives and why are they worse than what we do? And be transparent about that, because people are going to find out. And so it's a kind of a templated journey. And I think those tend to work quite well because you basically paint the picture for them to really work through why it is that, you know, your solution is valuable and why there's such a, you know, big opportunity attached to it. Does that make sense from a pitch deck perspective, Shirley? The opportunity sometimes is smaller than you might think. Like, I think a good example currently is Zoom. So we, you know, most of white collar developed world has worked from home. We've all been video conferencing. If Zoom has become such a big name that it's become a brand, right? So, you know, let's do a Zoom call. It's, you know, very familiar with people, even though this particular meeting is on Teams, but, you know, Zoom is very, very popular. They've grown by 300% over the crisis, and they earned about $2 billion of revenue. Sounds like a lot, but it's an established business that's really well funded. And $2 billion of revenue as the video conferencing solution for all of the developed world next to Teams. 2 billion doesn't even sound like that much from a step up perspective for a company of that size. So, but it's about, is it ubiquitous? Does it have good economics? And can you grow it a lot to everyone? And I think if you can articulate that in the pitch deck, then I think you're in a really good place. Then Fiona, question on how long would you allow to seek funding, Christmas break? Yeah, err on the side of caution. Seeking funding can take a long time. It can take many, you know, think about how much time it takes and then do it times 3 or 4, especially in Australia. It's, some people can actually, so when I was at Nimble, we did a couple of funding. So that was grown from about a 5 million revenue base to about 50 million revenue. At that point, we could get to a point where we could do rounds. So we could say we do a funding round and we ask people to subscribe to it. We do an advisor. The advisor peddles it in the US and locally. We set up a couple of meetings for people to come and, you know, test the waters and see what the solution is. And we could kind of define the pace. And that was a kind of a 2-month cycle to raise, I think, $6 or $7 million of equity. And we felt that was really fast, even at 50 million revenue. So assume this process takes a long time, especially if you have to build relationships first before you start asking for money, build those networks, and you have to invest a lot of energy into building those relationships. And then investors can sometimes they can sometimes surprise you with how quick they make a decision, and sometimes it takes a long time. But it isn't a signal whether they're enthusiastic or not, because there's a lot of stuff in the background. So sometimes I've been in a room where there was a circle of high net worths. We presented our case, and at one point someone says, "Okay, how much for 15%?" And so we said a number, and they go, "Yep, we're in." And so it was decided in the room, and you just don't believe what you just heard, that someone just decided to invest in you right there. In other words, someone is really enthusiastic, but there's something with their internal mechanics in their fund, or they're just cycling to a new fund and they love you, but it takes them 2 months to make a decision, even though they're kind of in. But the mechanics in the background take them a long time to kind of get to an investment. So there's a bit of variability there. Have a good relationship with that investor and with that set, but assume it takes longer, and don't put your company at risk by taking it to the last moment before you need to raise the money. Does that make sense, Fiona?
Yes, thanks.
All right, great.
Niel, Shirley had a follow-up question. Do you think having the terms drafted assists with the process? And quick introduction as well. Tim, thanks for joining. If you have a question, just pop it into the chat, and we'll answer that as well.
Awesome. Shirley, did you have something? I see that you're typing. Do you have a follow-up on that one, or is that a new question?
Oh, that's a new question.
No, I was going to send Tim a note to say he must have heard us saying there were only girls on the call, and that's why he popped in, but I decided not to be facetious.
Nice. All right. Yeah, terms drafted. It's
so
hard.
Can I just
because
clarify?
Yeah.
When you know how you told your first story about that deciding in the room, one of the VCs I was talking to, not for my startup but for another one, gave me the advice that especially when you're going to a round where you're going to have multiple investors, especially in a seed round, what they said is a really clever thing to do is to go to your lawyer and get them to draft the terms, work out whether you want to, how you want to do it, what the mechanism is. And they said that sometimes putting that on the table is a really good way of focusing the investors. Not that you're going to be, they said, don't get stuck on that, but they said that's an incredibly good way, because if you've got an investor who's like ready to go, but kind of doesn't have the mechanisms, they will often pick that up, amend it and run with it. And I thought that was a bit forward. And when I said it was a bit forward, they said to me, that's because you're a girl, which I thought was quite funny. They said, just be a bit more bolshy. And I just thought I would ask you what you thought, because that was coming from a male angel investor.
Yeah, I think it's good to kind of have, but then also just have an open mind that a lot of these investors will have a template they like, and a basis of, say, a term sheet that they kind of have, in their own back pocket on some of the standard things and that they would like to kind of put on the table. So it's a little bit like your general contract kind of negotiations when you're in a legal environment, right? It's like who does the first draft, and then you tick-tock back and forth. And so if you have your own draft ready, you can offer that and say, hey, I already have a draft of some of the terms that I think are relevant. Would you like for us to use that as a starting point? Some of them might go, oh, that's awesome. Yeah, no, please send me that. I'll have a read, because it saves them, the work to go through. And then it's up to them to go, no, actually, we have our own template we'd like to start with. So is it okay if we start with that one? And then you guys can fold in what it is you think you find important. But I like it. I think it's good to have. I mean, unless you're kind of trying to ram it down someone's throat and say, if it's not this template, then we're not doing an investment. But if you see it as a helpful thing, you say, look, we actually drafted something. We're in the legal tech space. We're quite good at this. We've drafted something up that we feel comfortable with. I'm happy for you to have a read to see if you think it's a good starting point. They might go, save me some time, send it over. It's great, because a lot of these will have similar clauses and terms. What do you think, Jason?
Yeah, and Shirley, you actually don't need a lawyer to be involved in the early stages, at least. Certainly not at the term sheet stage. There's a really good book by an investor called Brad Feld, and the book is called Venture Deals. I guarantee you 95% of VCs have gotten their education from that book. In a term sheet, there are basically two key items that you negotiate on. One is economic terms, and second is control terms. Economic being what liquidity preferences are there, what are the valuations, what's the anti-dilute like, all these kinds of terms. Control is about how many board seats do you give away, does the investor have preference rights, things like that. It's all covered in the book. I think it's really great, and it'll help you be able to negotiate with investors without even needing a lawyer for the early stage.
Do you mind popping that in the chat? That's awesome. Thank you.
Yep, sure thing.
I'm glad I asked.
Great. Any other questions at this stage from anyone before we move to? There's an Amazon link and everything.
There's an Amazon link for everything. That was the first thing that popped up, so that's the one I pasted in. All right.
Yeah, you don't. And Jason, you don't get commissions on this sale, right? This is not a side gig you have.
I should have set up an affiliate link before this chat, but unfortunately, I missed out on that. So. Awesome. So let's just go through the next question, I suppose. So Niels, can you tell us a bit more about boards and advisors and what that looks like? When do you have one, who sits on it, etc.? Yeah,
I think this ties into what I was talking about before around allies and around people that you surround yourself by to help you with your success. And I'm personally quite partial to having an advisory board early and start to invite people on who become a sounding board, especially if these people have knowledge of elements that you're not so comfortable with or that you want to strengthen yourself about. So if you go into the legal space, having people that know the little bit more about the technicals of your build. Someone who knows the industry really well, someone who knows the market really well, someone with a good brand and reputation in the market. One, it's a great sounding board you can formalize. So you can have, I give you even a YBF example. We started the FinTech Hub probably 3 years ago, and had an advisory board assembled with people that are incredible in that space. Just the value we as a team got from just picking these people's brains around where to go next and where the pain points were from a fintech perspective was just invaluable. And you can bring them into the party in a number of ways. So a common way is you give 0.5% of your company or 1% of your company to an advisory board member. That I see that happen sometimes. Don't have to. Some people just love to be involved in the first instance and just be formalized. You'll be on their LinkedIn profile as, advisory board member Elker. You can basically create quite a lot of benefits for people in the circle to be affiliated with a startup environment, and you get a lot from that in terms of advice, recommendations, and then also when you seek to have an investor round, people can go, who's been involved with the project. If you can name a number of very well-known people that have backed you and that are supporting you, even in an advisory board capacity, that often strengthens your case because you've managed to, get surrounded by really high-profile people or really helpful people, and that's, for an investor, is kind of a seal of approval almost, and a kind of a level of confidence that gets built around who you are as an organization. People can even use that for bad. If you look at the very famous Theranos example of these medical devices that kind of fell over. One of the reasons so many investors jumped on it was they had a board that had like Henry Kissinger or some of these really incredible names attached to it. And that allowed people to go, okay, I'll cut them a $2 billion check because look at all those names. So it's really powerful even if you use it for evil, but no one on this call is evil. So we can use it for good, right? So we can get a group of allies around ourselves and they can actually really help, push things along. And so I think that's recommendation one. And then, general boards, have a think about who you put on the board, but also be quite conscious with that stuff. Ooh, there's an interesting emoji there, Shirley.
I found an emoji for you, Niels.
Your blurb is being eaten.
That's cool.
So yeah, sure. So like you're commenting on that, it's it's amazing to have kind of an advisory board and make it about kind of the growth part. The growth part, I think, is something I'd like to highlight because sometimes people take an advisory board and they focus on, the structure, the rhythm, the sector, but what you're looking for really is sales, right? So how do you grow your business? If you can have someone who can open doors, someone who buys into, who can give you a vote of confidence, someone who can help you lift the business or give you unsalted advice around what's wrong with your current proposition and say, there's no law firm that would ever buy this because, and be kind of candid about this over a coffee or a Zoom call. That's incredibly valuable because ultimately sales fixes everything. And if your advisory board can help you with the sales component, that's crucial and it really helps. But it doesn't have, I think I see it really as levels of formality, right? So you can have allies around you that help you out. You can have mentors, that's great too. You can have advisory board members, that's kind of like formalized mentorship. And then you can have people on your actual kind of fiduciary board, and that you should be careful with, right? Because those people likely are going to be with you, they have an influence in your company. If you can get a great board member to join, there's a venture capital organization that loves what you do, cuts you a big check, takes a board seat and becomes this incredible voice of stimulus and thinking and brain trust at your board table, that can be an incredibly powerful ad. But you take the money from the wrong investor, and I've seen this too, also in the high net worth thing, there's people that love to invest, they cut a $2 million check, they join a board, and they're really unhelpful at the board table because they have different propositions, they don't give the right advice, they don't have a longevity in thinking, they're new to this. That could actually be a hindrance. So again, it's really important that you think of investing not just as the check that comes with the investment, but also who you're going to get attached to that check. Like who is going to be that person who is now influential in your organization? Because, between Jason and I, we've seen lots of organizations very close to us where we've had to unwind things between founders or unhelpful investors, And that's often a very, very hard thing to do when you're in the middle of a growth journey. It takes a lot of time and energy away that will be better spent elsewhere down the road.
Yeah, I think that's a really good point, Niels. Talking about, how I think the really important thing is to avoid deadlocks in the company. And there are a lot of deadlocks that can happen at multiple different stages. For example, if you have an even number board, you probably want to avoid that. Have an odd number board, so at least decisions can be pushed through. With founders, we've seen before that founders have special rights attached to either their shareholding or their board seats. So you can have 2 votes as a founder or a founder shareholder instead of 1 vote, which is great, for a founder. But some investors don't like that. And if you're a multi-founder organization, you have to also think what happens when if my relationship with my co-founder doesn't work out, and we give all these rights to the founders, are you going to suddenly find yourself in a deadlock if you are in dispute with the other founder because you have, the founders have an outsized portion of the vote, and and even investors can't help. So I think these are really important things to think at the start of your journey. People like Mark Zuckerberg, for example, as a shareholder, his single vote is worth 8 votes. So he's got a lot of power there, and certainly we've seen that in Australia a bit as well. So there's no perfect answer to this. But if you are a multi-founder organization, what I would suggest as an easy mechanism to avoid these issues is to have a vesting schedule in place for founder shares. So, for example, have founders earn shares over 5 years or 10 years or whatever it is, so that if a co-founder exits early, at least they don't take up the whole allocation and you don't find yourself in a deadlock.
Yep.
And yeah, Shirley, I see that you spoke about a mediation clause as well. I think that's a good suggestion to have in there. I also think that running a startup has a lot of stresses involved, and a mediation is probably another stress that you don't want to have. So I think it's a good idea to avoid the problem to begin with by putting in the right mechanisms in place.
Yeah, just so you know, I've done a whole lot of them, and the secret is to have a mediator pre-nominated, so you don't have a stress of everyone fighting over it. But with most of them, they've used the opportunity to recharacterize and bring in external investors and external board members at that point. It's been really effective and much cheaper than the shit fight in court.
That's great advice. Thanks, Shirley.
Yeah. Actually, something I wanted to mention somewhere in this conversation is thinking ahead a little bit with some of those early choices you make, because as you also know, Shirley, and some of the stuff that you've seen in mediations and stuff that happens, there are a few things where there are a lot of things where the long term kind of doesn't matter. You can make quick choices now and use a lot of duct tape to get going, and that's fine. There are a few points, especially around how you structurally set yourself up and investments, where things can really bite you a couple of years down the road, and you have to see yourself as a wildly successful business. So if you assume that you're going to be a business that has 300 staff and you have grown to an enormous footprint and you're selling internationally, that can be stuff you do tomorrow or a week from now and a month from now that will become an incredible consumer of your time and stress, and to use Shirley's technical term, shit fights down the road. It's something, there's a few things around how you set up shareholder agreements, how you set up term sheets with initial investors. It does pay off to have a little bit more attention to some of the pitfalls that you see, and there's lots of research there. There's checklists, there's help you can get, advisors you can pin. There's not an easy list of 5. There's just a few of them to keep an eye on. Investing, for example, with founders is one, to make sure everybody continues to work on the right kind of assumptions, and you don't have a 300-person business a couple of years from now where there's one person owning 20% of the company that hadn't been part of the company for 95% of the journey. So there's a couple of things you just want to think about. It's tough conversations between founders sometimes. You have to get ready to have an honest chat. A little bit, sometimes this is a little bit like you go into a marriage with another founder. It's a very trustful relationship, but you just have to put some stuff in place, like life insurance. It's a hard conversation with the partner to have, but it's a worthy conversation because you really protect yourself from the risk down the road. And with investments and structurally setting up of your company, it's just something to think about, that there's matter, but there's the 5% that can really bite you if you're not careful.
Do you have a
Awesome.
checklist on that? That's such good advice, Niels, and it's the kind of thing you don't really think about. Do you have like a checklist of these are the 5 biggest mistakes that I've seen that you should avoid now? Because I can put that on my fridge with your other advice.
It's a really good one. We don't actually, but there's a lot. You know, I think maybe it's one of the content things that we should have a chat with Courtney about, Jace, because I think that could be a really interesting thing to put out and have kind of as part of our set, because it would be easy for us to compile them. They are around, shareholder stuff. It's about shareholder agreement stuff. It's about vesting for founders. It's around, those kind of things. So making a checklist would be an interesting exercise. Actually, it's really good feedback, Shirley.
And Niels, what would be great is, like, we all know that it's the shareholders agreement, but what would be fantastic is if you said, these are the 3 clauses you need to sweat over.
That's right. That's a good.
Because most of us are duct tape people, because if you're not duct tape, you're not going to get going. So I want to know, Shirley, sweat over these 3, spend the money on these 3 pieces of insurance, have the difficult conversations with these 3 things. That would be just godsend.
Yeah. I suspect drag-alongs will be on there as well.
Which one? Sorry?
There's clauses like tag-alongs and drag-alongs, which is basically people can force you to go along with the decisions that are made, and those often come up as well as things that where you get some acrimony around forcing people into certain decisions. But yeah, that's great advice. We should definitely have a think about that. So thanks for the input. Great. Any questions on this part of the conversation that we haven't raised yet?
All right.
I'll wait for some typing. All right, great. Jason, shall we go and talk about? We've kind of talked about what we know and most people don't, and myths and commonly conceptions or misconceptions. Anything that you haven't covered that is on the back of your mind? I can talk about an annoyance I have. In this space, in this space, there's one annoyance I have. The annoyance is, in the current environment, there's a lot of attention on valuations. So a lot of people talk about a unicorn, someone worth $1 billion, right? Or someone whose stock on the stock exchange is up. The thing that I think is going to bite us on that, and I've had some chats this morning with some of our own advisors and potential investors on that, is that people lose sight of the metric that's actually important, which is revenue, is your revenue growth. So if you look at some of the people that are the highest value at the moment, actually have quite underwhelming revenue numbers. Like even your Afterpays, well-known startups, if you really peel back what it is that they're currently making in pure play gross revenue terms, it's like 150 million gross revenue. Like it might be worth 6 billion on the stock exchange, but kind of who cares? It's good for the investors and for the founders. But what you really want to watch is 150 million of gross revenue in an industry here domestically where retail finance is 158 billion a year. And the revenue of the highest flying startup we have is 150 million. That means that either they have a lot to grow still, or their product, finance, the product economics are so marginal that from all this growth they've achieved, they actually don't extract a lot of revenue dollars from it. So when you think about your own growth, my recommendation is don't fall in the trap of talking about how valuable your company is, because you do get a kick out of that when someone values your company at 50 million and they want to invest 8 million. So, on a money valuation, they're taking percentage points of your company, but implicitly now, oh wow, look at the equity we've built here with our project. It's now 50 million. That sounds amazing. That is great, and celebrate it. Roll out a cake, whatever you feel. That's fantastic, but keep your eye on revenue. Keep growing the business. Keep finding new customers. Make them feel great about your product. Make them tell all their friends. Make those people come call you and say, can we have a look at what you're doing? Because everyone's ranting and raving about your solution. It is just so much better than what we have. Keep striving for that, because I think then the valuations will easily look after themselves. And that's a much more healthy kind of area to focus on, even in front of investors, because investors know that. So they'll go after someone with revenue traction 5 times more than someone with a bloated, valuation that they can't live up to. So that's kind of the one thing that I think not a lot of people are talking about, that more people should talk about in this space of what's important.
I do have 2 things. The first thing is, oh, sorry, is someone else talking?
No.
Oh, that's weird. So 2 things on my end. First thing is, work ethic. And, the reason I bring this up is because as founders, I'm sure that, you live and breathe your startup, and you wake up at 6 a.m. thinking about the company, and you sleep at, 1 a.m. trying to figure out how to raise that next bit of capital. What we've seen is that, sometimes your team members don't share that same level of enthusiasm. In Australia, at least, in Melbourne, life is quite nice. We've had a couple of startups where, they have developers on board, and, they clock in and clock out, and sometimes, and that's great to some degree, but, sometimes it does present challenges as well. When you need to get that last bit of output or that last bit of deliverable out to meet a customer, sometimes it's hard to get that output. So, one thing that you should probably think about at the start to align your team with you is, having an employee share option pool. And that's something that you should really, think about incorporating at the start, especially before you go into conversations with investors as well. Set aside 10% of your company, or, 12.5% of your company as a pool to distribute to some of your early employees. And especially if you're thinking about a CTO or a C-level person, having that bit of equity for them really goes a long way in aligning their outcomes with your companies as well.
Yeah. That's fantastic, Jason. It's a term that you're probably familiar with called the cap table. So the capitalization table. So who owns shares in your, basically a table with names and then the amount of shares that each of those names owns. You can create a picture when you're talking to investors around, currently our cap table looks like this. It's the founders that own 100%, or it's the founders that own 100, one person that's giving us some money that owns X, and another person that owns Y. That's pre. Now you're doing an investment, and afterwards it'll look like this. And that's a good point to go in and say, the future will be these many shares for this one. You will come in, dear investor, and will get this many shares, so that's where you can derive your percentage ownership. And then there's another line there, that's the employee pool for options, where you carve out 10% and you add that to the pile of shares that the new company, or the next iteration of the company will look like. And then you can be transparent with the investors around, this is something we want to do, because obviously those investors will get some dilution from that. They will own fewer shares by that 10% being there, but investors are quite open that's a conversation you want to have. They'll just might want to debate you around where those shares are coming from and who gets diluted more or less versus themselves versus you. But I think most investors really appreciate you doing that because of that work ethic and skin in the game dimension of getting some real talent to join you, because you're just not in a position to pay people top dollar. So you have to incentivize the top talent to come and be part of your journey. So another interesting Afterpay example, one of the early executives they peeled away to come and help them grow has left. And I think that their salary was nowhere near what they were earning. But I saw a couple of months ago that they exercised some of the options they had from the early days, and it was worth $31 million. So they're kind of done. And so getting that skin in the game early for companies that end up being wildly successful is an incredible way for people to, be part of the success of the company going forward. So having that transparent conversation with investors around that's something you want to do, and carve out a piece in your cap table that is allocated to your employees as part of something you want to hand out in terms of options. I think people appreciate that when you're transparent and you're doing that early enough.
Yeah, and it's something that you can't do as you raise more money, because you're effectively telling the investor, if you do it after you raise investment, you're effectively telling the investor, hey, we're gonna reduce your percentage ownership by 10% just because we want to create the pool. So it's something you want to do up front. Even if you never end up exercising the pool, even if you never end up giving away the options, at least have it in there so that you have the option of doing it, and it doesn't cause any issues with investors. Cool. Any more questions on the topic, or? We've got a couple more different questions to cover. Great. Let's just move on to the next one. So Niels, how are you finding the Australian market right now? And are there any trends or observations to share?
Yeah, I just wish our investor market was 5 times bigger than it is. I think there's a bit of a demand and a supply issue. If you talk to a bunch of the investors and the VCs that are here locally, some of them might say, I wish more promising companies would come our way. It's not that they're being stampeded and they just don't have the funds. Their own perspective is actually, we'd love to see more promising startups that have a good track record, that are growing, that we can back, and that will become the next superstars. But vice versa, a lot of the startups are going, look, I wish I, got more access to investors, and I wish there were more funds that we can avail ourselves of with bigger ticket sizes. So there's kind of this two-way demand supply kind of issue at the moment. I do think that, for example, our super industry needs to tilt more towards this. They're currently not. They are thinking about it, but the problem is that if you're Australian super, anything under 100 million investment fund, just you send that to a fund manager, they will manage that for you. You're not going to go and have conversations at the 3 or the 4 million mark on your own accord. You go through 2 sets of intermediaries before that hits anywhere, and that's a hard putt. And so I think with one of our larger, pools of funding in the world or in this particular space, we could access that as a kind of a nation to help with the growth capital, and that's currently not happening, and I don't think it's happening anytime soon. So we definitely don't have one of the better investment markets. It's definitely tougher than most places. It is a more conservative crowd, but I don't want that it's not like it can't happen. People do get funded, people do grow, people do their Series A's and B's. It's just harder work than if you were in, Stockholm or Israel or the US or the UK for that matter. There's, a lot of people that end up deciding to decamp, which I think is a bad call, but a lot of people actually do that purely because it's easier for someone to go, look, you're going to be a $50 million company revenue. I'm going to cut you a $3 million check, and I want to be part of that journey. There's just conversations that don't happen here, in the scale that we have. So it's definitely word of caution that as a startup, you have to work that really carefully and really hard at the same time, have early conversations, early relationships, and then it can happen, and it does happen. But I do think it's harder work here in the market than in some other kind of more developed geographies. What do you think, Jason?
Yeah, this is such an interesting topic, and I could go on and on with it. In some ways, again, it's been better than ever, and it's improving day on day. There's billions of dollars being put into venture funds right now. Several funds have $1 billion under management. I think going back to Niels' issue, the issue is really the lack of diversity and the lack of quantum of investors. So, if you have 3 investors with $1 billion each, you're still only pitching to 3 investors with very specific areas of focuses and very specific opinions on whether they want to back you or not. You might be building a company that has nothing to do with one of the areas that they invest in, and then where do you go? I think that's an issue. We need definitely a lot more diversity of investors, not just a lot more money. We need the money to be spread out to different groups of investors. In terms of angel investment, what I've found as well is that angel investment activity has actually decreased over time here in Australia. And I think that's a function of, those 1, 2, or 3 big venture funds doing very well. Because they've done so well, the angel investors have a choice. Do they invest directly into companies, or do they invest into one of these mega successful funds? And I think, the preference is obviously to, make a return on their capital, and they'll put money into these funds and, do no work to get a return because they're so successful. So I think in some ways, angel investment has actually been a lot harder. So, the more recent trend I've seen is a lot of seed funds starting out, because there are a lot of new investors in the market who have realized that there is a gap, that you've got all these big funds, but not a lot of people funding the smaller side of companies. So keep an eye out for some of the newer funds that are coming out, specifically to the seed stage. As a fund grows larger and larger, even though they say they're going to do seed investments, practically it's going to get harder and harder, because $1 billion fund can't make hundreds and hundreds of $50,000 investment. It's just not practical, and they need the return, so they invest at later stages. Yeah. Great. Any more questions on that front, or should we move on? We've got 2 more questions left. So cool, let's move on. Second last question, Niels. What companies do you find most interesting at the moment, and any stories to share with us about the scale-up journey to bring this to life?
I think we had a session yesterday with a whole bunch of people that were specifically around the PropTech space and looking at how to adjust to kind of COVID and buildings and having safe environments. And some of the innovations there in the cusp of hardware and software combined were fascinating to me. So how do you make something touchless? How do you measure areas well? How do you use robotics and autonomous kind of entities to do work so you don't have to have kind of humans in those more dangerous areas? Doing a lot of stuff around the particular kind of tag-ons that you could do to the current environment. So you don't have to overhaul things, you can just add something to it to make it touchless or have a better scanner there. I think there's some fascinating things there where people are adjusting to kind of a new environment. Also, none of us really know kind of how much mean reversion there will be, right? So we've had this crisis in COVID, but are we going to go back 100% to the world that we had before? Because people are creatures of habit and, you're going to just go back and revert to type? Or is it going to shift by 40% and some facets change forever? Or is there going to be a wholesale revolution where things are dramatically different and nothing will ever be the same? No one can predict this, but startups that cover the zone and say, no matter how much change there will be, this is a trend that will continue and we can capitalize on. I think I'm fascinated by people that do that well, that take that uncertainty and still be able to have a really good sales story to their clients around, no matter what scenario will end up being, this will become something that's important for you to get ready for and, be better suited, in the new world to kind of work through. So I think those are the things that really fascinate me in the current environment.
Awesome. And last question for you, Niels. Do you have any parting advice for companies in startup or scale-up mode?
None. I mean, I think we've talked a lot about the different topics here. It's been quite a nice kind of back and forth kind of conversation with things that were raised. I think find out what you're walking into, find out what is worrying you, find out what the pitfalls are, and create allies around yourself. And also, now that you're part of this kind of program, just raise issues if you have concerns you walk into. That's what we're here for. The Landers team's here, YBF team's here. We're available. So set up an hour time. Take us through questions. Pick our brains. Let us help you connect to people that might know the answer if we don't. That's really what the program is for. So. For the time remaining on the program, but also after, we work with alumni all the time. Really feel free to kind of use us as part of your group of allies now and let us help where we can, if we can.
Thanks, Niels. Sorry, Stephen.
That's great. I think we're just running up close to the end of the time and perfectly timed, you guys. So thank you both. A big virtual round of applause for both Jason and Niels for that. Great questions from the audience, so thanks, and that's what makes it really valuable. These information sessions, I think, even like not only do the participants get a lot out of it, but it's really good to see there's an exchange on both sides. I think just to wrap things up, and we were talking about this earlier for those who had joined right at before we started, was there's an upcoming pitch and lessons learned session coming up on the 15th of December. As Tatiana kind of alluded, this is kind of our little bit more of a wrap-up event that we'll have. So we've kind of grouped you guys into 2 different groups, where some of the ones that are running pilots with us at Landers, lessons learned and their experience with us. And then for those who haven't been, to use some of this information and actually just do a trial pitch to our panel. So that will be Genevieve, Farley, and Simon Davidson. So both sides on YBF and Landers will be there. I believe Niels and Jason, I think you're going to provide a little bit more of a sample pitch deck for our audience as well. So look out for that. We'll be attaching some of the materials as well as some of the information shared on this chat, just as a recap of our session today. And I think I am not wrong, but I will also offer up Niels and Jason to do some pitch support leading up to the day of the 15th. So please feel free to reach out to them directly for kind of follow-up questions from this session, as well as just in preparation for the session on the 15th. Any last things from everyone? Okay, let's wrap it up. Thank you everyone for joining.
Thanks so much.
Thanks everyone. Take care.
Talk soon.
Very much.
See ya. Bye.
Thank you.